perspective, there are things that you can be concerned about. But overall, I think some of the CapEx increases tied to memory price increases. So that's transitory. And so from that perspective, there's not much to make out of, the fact that they have to pay up along with everyone else when it comes to memory prices.
We found the T word years ago, Mandeep. Thank you. Mandeep Singh of Bloomberg Intelligence. Appreciate it. Thank you very much. Gil Laureate of DA Davidson, maintaining a neutral rating, 375 price target on Alphabet, writing growth at these rates is remarkable for a business about to cross $100 billion of revenue. CapEx guidance was vague, very banana, but it leaves room to interpreters. See how the more in the studio. Let's get to your reaction to these numbers. What's the out for you?
Yeah, sometimes it's not the number, it's not the content, it's how you say it. When CFO Amada Kanai talked about 2027 CapEx, she said it's going to be significantly higher. And she put some mustard behind the significantly, and I can watch my Bloomberg terminal and see the price after market go down by, and as she said that. If she just put a little bit less zing on it, maybe the market wouldn't be reacting to that.
Communication failure, and just that.
I don't think it was a failure. I think she wanted that.
Well, okay, but the larger question here is, does that create a problem for a company that is growing at a really rapid pace? I mean, John's point earlier, don't some of these numbers justify increased spending if they do have a backlog that's increasing to $514 billion from a $460 billion just a quarter ago?
Thank you. These numbers justify the investment. I can back into about $20 billion of excess returns Google is getting from investing in AI. That's double-digit returns. When we talk about ROI and concerns about ROI, the numbers are already there for return. Now, for a company like Google, one of the best businesses ever created, you would typically expect more than 20% return. So it's not their best return, but it's also strategic. They have to stay in the game. They have to be competitive with Amazon and Microsoft in deploying compute, and they have to be competitive with Anthropic and OpenAI on the frontier model. They are getting returns. That's why they're continuing.
At the same time, I do understand the nervousness around the cash burn. Suddenly, the cash cows of the universe are becoming the cash burners, and that is very uncomfortable for people. And so the first quarterly cash burn for Alphabet in its history going back to 2016. Does that give you pause, saying even if this is a very good company, we need to re-rate the valuation?
It has to. It has to. Again, one of the best businesses ever created, and we're now in negative cash flow. And that's probably going to happen to Meta, and it may even happen to Microsoft and Amazon. And so we do have to stop and say, are we sure this is working? And I talked a little bit about Google's returns, but there's also the bigger picture. We're now at more than $100 billion run rate of overall spend on AI. If you look at Anthropic's run rate and OpenAI's run rate, they're talking about 70 and 50 billion respectively. That doesn't even include any other AI. That's real consumers and real businesses spending on AI. And guess what? The models aren't even that good yet. OpenAI and Anthropic in their labs are sitting on models that are far better than they're giving us access to. So by the time we all figure out how to use AI better, we're going to be spending a lot more than that. So we are getting in return. But clearly, having a negative cash flow for all these phenomenal businesses is something that should give us hope.
So Apple's the biggest spender so far this year. Amazon's latest guidance was $200 billion. Do you think they're going to have to up their CapEx when they report next week?
It's likely, if for no other reason that component costs are higher. CPUs are more expensive. Memory is a lot more expensive. Hiring technicians to install HVAC is a lot more expensive. Energy is a lot more expensive. So they're all going to have to increase their guidance for this year. What's going to be even more interesting is to see what Microsoft says about next year. Because Microsoft is going to be at the beginning of their fiscal year. So they're going to give us a hard number for fiscal 27. That's the next 12 months. And we're going to know a lot about how much more CapEx is going to get deployed when they let us know about that. Now, if they guide something like 20, 30% more CapEx, I think everybody will take a sigh of relief. But if they guide for more than that's 40% growth, which is how fast Azure's growing, maybe there'll be a little bit more.
The chip companies are getting paid. We saw that this morning. Howard was talking about Micron. I've asked this question earlier this week, and I'll ask you to you as well. What your reaction? Do you think of a world where these names, the hyperscalers, Alphabet, and others do well, and chips do well too? Because right now in the stock market, at least, that's a struggle.
That's right. If we continue to use AI more, we're all using AI so much more. Again, companies are spending so much more on AI. As long as that trend continues, as long as the diffusion into our lives continues, they will all do very well. They will all do very well. In spite, the ones I actually worry about more, Anthropic and OpenAI, because there will be American open source companies. We can talk about Chinese open source for now. That's not a real thing. We're never going to build systems on Chinese IP. When there's American open source, a lot of the value is going to go there, but then there'll be more value to flow through hyperscalers into chip companies and into companies that make the chip making.
So when you think about who's going to make the money, which layer, infrastructure, the frontier models, you've already got conclusions on that.
Yes, the hyperscalers will make the most consistent revenue and cash flow, and the semis companies will continue to grow. It's going to be more lumpy. There will still be cycles, but we're going to be a much bigger size than we've ever been.
How was the World Cup?
It was phenomenal. And Spain is masterful.
I enjoyed the game.
Absolutely.
Nice being in the stadium.
That's
Yeah. I like to think they're here to see us, but they're just here to watch the World Cup final and then make an appearance a few days later.
I'm okay with that. It was wonderful to see him in person.
Gil, thank you, buddy. Thanks for dropping by. Thank you. Gil Lewis there,
right.
D.A. Davidson on the World Cup and on chips and hyperscalers. Let's give an update on news elsewhere this morning with your Bloomberg brief. Bonnie Quinn has more. Hey, Bonnie.
Hey, John. U.S. House Republicans approving a budget framework for a $95 billion package. It's part of a two-step process that would let Republicans fast-track $73 billion for the war without Democratic votes and allow for billions more in aid to farmers hit by tariff retaliation and war-related price increases. Paramount's $110 billion deal to Warner Brothers getting conditional approval from the European Union. The green light coming after both companies agreed to address concerns over competition. The merger still facing a U.S. lawsuit over concerns it could harm competition. Comcast earnings are beating analyst estimates. The company's media division boosting revenue by 25% thanks to a series of must-see events, including, of course, the NBA playoffs and the World Cup. And its Peacock streaming platform reporting its first ever quarterly profit off the back of all that. That is your Bloomberg brief. John.
Hey, Bonnie, thank you. Appreciate it. Up next on the program, bracing for higher inflation.
The Iran war is fully back on. If you're looking at the impact of higher oil prices kind of feeding through to all of the other economies in the world.
Crude up, bonds down, yields at levels we have not seen so far this year. Veronica Clark of Citi joins us next.
Oh, hello there. Just wanted to say, Primer is back. Scouring the frontiers of science and technology to help explain the difference between the next gold rush and whatever listening is. And in season 2, where mistakes, more danger.
Now that is some high-grade uranium mineralization.
We have a stable climate on this earth. Right now, we do not.
More science.
They're pushing the envelope of technology in multiple directions: software, hardware, chemistry, physics.
The cable is like very cold.
More CEOs that can nail the photo shoot.
Hundreds and hundreds of billions of dollars are at stake. While the problems are economic, the solutions are too.
And yes, we will be talking about AI.
There is a lot of humanoid hype out there.
But our fiction doesn't run on hype. It runs on innovations. Watch season 2 on all these lovely channels.
It's the world's second largest economy with a growing influence in global affairs. Bloomberg The China Show brings you the unmatched expertise you need to keep track of breaking news, in-depth market analysis, and the most influential newsmakers in and around China.
We need to do more to engage the market more. We're risk on. I think we caught a little sweet spot.
Massive savings right now.
It's already a different game.
Bloomberg The China Show. Weekdays around the world, right here on Bloomberg. Context changes everything. From the world of politics to the world of business, Joe Matthew and Kaylee Lunds deliver news, insight, and analysis live 2 times a day, every trading day. Balance of Power at 1 and 5 Eastern, only on Bloomberg. U.S. jobs numbers are released. Bloomberg has the report under surveillance with crucial data and expert analysis at criminal speed. Nobody covers jobs day like Bloomberg.
The top 2 stock stories so far this morning in the pre-market, both of them not doing so well. Alphabet down by 4%, Tesla down by close to 6%. Alphabet putting up decent numbers for the quarter, overshadowed by a big capex figure and some strong guidance for more. That's weighing on the stock. We're down by close to 4% in the pre-market. Weighing on stocks more broadly, equity futures down across the board. On the S&P, negative 0.2. On the Nasdaq, by about 0.25%. It's not too dramatic, is it? Because the chip stocks are running, going to spend more, they receive, and they like it. Those stocks have been doing better over the previous 3 days. They do better again this morning as well. We're still within 2% of all-time highs on the S&P 500. And the chopping and the changes between the hyperscalers and the chips, that story is volatile. It continues. In the bond market, yields up across the curve, particularly at the front end of the curve. 2s in focus, new high for the year. 431 up a single basis point off the back of this move in crude. WTI and Brent this morning closing in on triple digits, up 5%, 90 yen. On Brent crude. On the surveillance this morning, bracing for higher inflation.
The Iran war is fully back on. You're looking at the impact of higher oil prices kind of feeding through to all of the other economies in the world. Inflation expectations in the US have been somewhat contained, but the market is fully pricing in a hike by the end of the year. So at some point, the market's going to dictate to the Fed what the Fed should do.
So here's the latest this morning. Oil rising for a 5th consecutive day, fueling expectations possibly for tighter monetary policy. Veronica Clark of Citi writing, front-end yields have moved higher with energy, but we think markets are underappreciating the extent to which softer CPI will raise the bar for Fed hikes. Veronica joins us now for more. Veronica, good morning.
Good morning.
I'm smiling because I know how difficult this is. Last week, soft CPI, soft PPI, and I think I said to you, it's okay, the argument's easier for you now.
Yeah.
Is the argument harder again?
Yeah, a bit. I mean, markets are pricing something like a third of a chance of a rate hike next week. I still think, it will come down to the data. We did have that very soft CPI. It was typically negative on the month. That's really rare. And it was very broad-based weakness. And we're finally seeing core PC inflation that's annualizing close to 2% on a monthly basis. So I do think Fed officials will at least want to see more months of data. And I think what they're going to see in those more months of data is core CPI actually dropping pretty quickly. We'll have that, I think, at about 2.3, 2.2% within a couple months. Monthly readings for core PCE, I think that will also look more favorable. And then you get to late September and you get those revisions to core PCE, and I think those will be lower, and it should at least make you question the signal that you're taking.
You say Fed officials will be maybe waiting for more data. Some people make the argument they've already got what they need. We've got the problem in energy. We've been above target for a long, long time. The problem in energy persists, and we've just heard from a bunch of tech companies that wanted to spend forever a whole lot more. Of course, I'm stretching the truth. Neil Duffer published yesterday. He reckons there's a good reason to go as soon as next week.
I mean, I think, if you're obviously worried about inflation expectations, and we're watching the impact of energy prices and how that feeds into core inflation. But that has not happened yet, right? We haven't seen it yet. There has been evidence in some other data this year in the details of like the University of Michigan survey. People are saying it's a bad time to buy because times are bad and affordability is an issue. And I think that's going to prevent a big increase in core inflation from higher energy prices. People are not acting like they expect higher inflation.
Okay, it's one thing to say they're not going to hike prices next week. It's another thing to say if they're going to cut 2 or 3 times later this year. How can this be a Fed Reserve that is poised to cut when you have Beth, Lori Lynn, Bill Kashkari, pick your Fed official other than the one who isn't speaking, all seeming to want to raise rates in some capacity or at least remain on hold?
Yeah, something's got to change in the data, right? I think the inflation data the next couple months can get us to price out those hikes. To actually get to cuts, you have to see something in the labor market data. And I think we will. We've had this big decline in labor force participation that's kind of capped the unemployment rate. But the trend the last couple of years is that you see that reverse late summer, early fall. You start to see some softer jobs data then, and you start to see the unemployment rate rising. So our forecast, I think we will see an unemployment rate that's closer to 4.6, 4.7. And then, of course, CPI is at 2.2, 2.3, and unemployment rate is rising, and those balancing risks have shifted a lot.
I remember when Mohammed El-Arian used to say, listen to what the companies had to say. You can get a really good read on where the consumer is. What we've heard from the likes of Capital One, outperforming because charge-offs came in so far below what they had expected. Charge-offs broadly in the financial industry came in far below, and the provisions for credit losses. You're seeing pretty much every metric of the consumer, putting Pepsi aside, do pretty well. And doesn't that give you a sense that things aren't so bad?
Yeah, it's not that the consumer is breaking. We did have some pretty soft real consumption in Q1, though. We do have real income growth that is pretty much flat on an annual basis. Obviously we have higher tax. They had some larger tax refunds. Maybe that's helped to support the consumer for a little bit. But I do worry that now that gas prices are higher again, that does kind of act as a tax on consumption. Again, we see people saying that they're not spending.
Tariffs. Can you look through everything? Higher oil prices, higher inputs when it comes to potentially tariffs.
Yeah. I mean, this is where it's important to look at that final consumer's, inflation data, right? That's where we're looking for the signs of the pass through. I mentioned how consumers are maybe not spending this year. In that same University of Michigan survey, we actually did see consumers say that now is a good time to buy because we're expecting prices to go higher. You don't see that this year. So I am, cautious that you might not see that pass through.
Monica, it's on a good sign for looking for cuts later this year. Still 2 or 3. Where are we at?
2 this year, 1 next year.
Okay, all right. So push that a little bit. All right, then. This is the new data note from RenMac. If you are a whore, you simply stimulate with a lot of visibility on what the next few months might look like. Moving this into a boatload of capex, AI demand is perking down. With these tensions of work, and they're not putting up gas prices into all of the now doing what he calls Trump things, again with tariff. As I'm to say, you don't need any of this has been 5 years now. You just talk about the next 5 months.
Suddenly, there's a 36% chance the Fed is going to hike rates next week. And that had been close to zero after the CPI and PPI came out. So increasingly, people think that there is a greater chance that Neil Dutt is not wrong, that the likes of Lori Logan and Beth Hammock and Neil Kashkari and whoever else come out and say, all right, if we want to hike rates, why not do it now, especially when we don't have to give forward guidance anymore?
At the very least, I'd be surprised if there wasn't any percent next week. Next Wednesday, you have to think one of them makes the move, sticks their hand up and says, let's go.
Maybe that's why there's going to be a press conference. Maybe because he can explain why there was a dissent. I mean, it's sort of interesting. He only speaks when he has something to say. So he has something to say next week because evidently, as we learned yesterday, there isn't going to be a press conference.
I've heard him say that, and then I feel him on the panel and it's interim and thought, okay, maybe we just read them, he's got nothing to say.
Oh, my gosh,
You're all the same way sometimes. Coming up next, Morgan Stanley, French Hill, Ben Callow at Baird, and Darren Matt. Just go see the second hour of Bloomberg Surveillance just around the corner.
Every weekday, Bloomberg puts a spotlight on a different aspect of global finance. Flows, funds, and the forces shaping markets on ETF IQ. The future of money with Bloomberg Crypto. The players behind major transactions on Bloomberg Deals. Rates, risk, and the cost of capital on Bloomberg Real Yield. And personal finance, retirement, and wealth management on Bloomberg Money. A different topic every weekday, only on Bloomberg Television.
Do you mind being called an ideological lunatic or a bunch of left-wing nut jobs?
I've been called worse things than that.
You think she owned the place.
23andMe, I think, is so incredibly valuable. We're coming back.
It had that kind of detective story feel to it, you know, when you're hot on the trail of something, you know that it's very exciting. What magazines were you reading as a kid? I think I was reading magazines until I was in them. You are on the cover of all of these.
Oh, and there's many, many more, but we just don't have time.
Why should people trust you? I don't think anybody can trust anybody or entity completely with any.
It's very uncomfortable. Artificial intelligence is the core of it.
Or to build better businesses around these brands. The shock will never wear off. So you're a brother and sister running one of the most powerful companies in the world. When you argue, who wins?
No one. The way I could see AI being banned or blocked is if something really went wrong. And if something really went wrong, then maybe it's adversity.
So is it Paradise in that or Gattaca? Maybe somewhere in the middle.
Technology is embedded in every aspect of our lives, and that revolution is playing out in real time. From finance to defense tech, AI to entertainment, from the road to the stars. Bloomberg is bringing you the stories of companies and people that are pushing tech to new frontiers and the politics reshaping global tech markets. I'm Ed Ludlow, live in San Francisco, and this is Bloomberg Tech. Every weekday, only on Bloomberg Television.
Investors, top executives, global innovators, join me for in-depth conversations with the biggest newsmakers on the day's top stories. Insights with husband on it. On Bloomberg. Good morning, this is Bloomberg Great Europe. I'm Lizzie Burden in London, and these are the stories that set your agenda.
Taking you from the US markets close to the overnight session in Asia. We'll walk you through what you need to know to kickstart Europe's trading day. Live from our European headquarters, we bring you the day's top market moving stories, unmatched expert analysis, and on-the-ground reporting from across the continent. Tune in to Daybreak Europe, only on Bloomberg Television. Content changes everything.
You're not where you need to be on inflation.
Interest rates may just be too low for the level of inflation that we have.
The economy is still fundamentally in a good place. There's not an urgency for the Fed to hike. Inflation is not hot enough to really see the Fed doing that.
This is Bloomberg Surveillance with Jonathan Farrow, Lisa Abramowitz, and Anne-Marie Verdern.
Live from New York City this morning. Good morning, good morning. For our audience worldwide, the second round of Bloomberg Surveillance starts right now. And your price action looks like this. Equities declining by a third of 1% on the S&P, on the Nasdaq. No drama here, still within 2% of all-time highs. Some violence beneath the surface, strong word on that. We'll talk about Alphabet and Tesla in just a moment. In the bond market, some trouble. 2s, 10s, and 30s, new highs for the year. The 2-year this morning, through 430, up a single basis point. The 10-year approaching 470, and the 30-year comfortably up 5% for quite a while now. If we turn to the commodity market, the Y looks like this. Brent and WTI pushing higher. Check it out. If you took a few weeks off for the summer, welcome back. We're no longer in the 60s. We're in the 90s on WTI, 98 on Brent, and threatening to break into triple digits.
I think nobody really took the summer off. And I think that what you're going to hear is that people have been trying to ignore this story as they look at all of the capital markets booms that have been going on. And the question here is how many pillars of the market are being challenged? On one hand, we have this question, big tech continuing to outperform, but continuing to raise tons of cash. At the same time, the oil crisis really pushing everything higher. And ultimately, there is no solution here. When you talk to experts, what's the exit strategy in Iran that can actually cause some of the oil flows and other commodities through the Strait of Hormuz and, frankly, the Red Sea? Well, this administration clearly thinks that they can try to get the Iranians to a negotiating table by having them capitulate, by continually having these attacks, which we saw last night, the 12th straight night of attacks. So the Iranians are saying, well, actually, we're going to have our proxy now get involved. It was a threat. Now it's a reality, and the individuals I'm talking to this morning are saying none of this is a surprise. If you have been paying attention to this conflict and how these people operate for decades, none of this is a surprise. The question is, what's the plan going forward?
Crude in the driving seat. Look at what it means for rates and the outlook for interest rates as well. 2's at 430. again, even within the last week, softer CPI, softer PPI. Check out tens pushing 470. 10-year yields are basically at the height of the year. And it's not triggering a response where we see a risk aversion story build in equities and money goes back into bonds. What's interesting about this moment, Framo, and you touched on it an hour ago, is that people aren't willing to step in to buy these yields in quite the same way as they might have done in the past. That we're holding on to these levels for longer than I think many people thought we would.
Yeah, you pointed to the study that Bloomberg did about how we're seeing the longest streak above 5% in 30-year going back to 2007. Part of this is just because the economy isn't crashing. And this is what Russ Costridge said. If the economy is not crashing, it can't act as a counterweight, as a hedge to equities. Also, there's so much competition. This bleeds into the tech story as well, because if hyperscalers are selling $20 billion bond sales as if they're selling lemonade, suddenly you got a problem if you're also trying to sell 60, 70, 80, $100 billion of a treasury. So all of these things leading to also a global story, because the dynamic is happening from Japan and from Europe.
It's the crowding out dynamic we spent a lot of time on this program. Coming up later, 8:15, an ECB rate decision. Look out for that. Look out for this too. Some data at 8:30. Joffa Springs will come. Then we'll go around 2:15 into the story. If it changes, that's news. We'll see if it does. 8:45. ECB President Christine Lagarde. I'm picking that to Isabel Schnabel, an executive board member of the ECB, just a number of weeks ago, saying you can no longer look through this show. How strong is the hawkish argument of these central bank meetings today at the ECB and next week at the Federal Reserve?
So they have to respond to markets that are increasingly pricing in almost 2 rate hikes by the ECB after pricing in just 1 before this conflict reignited a couple of weeks ago. So ultimately, you can hear the hawks come out and out hawk any doubts left, but I don't think there are any doubts left right now.
Futures down by a third on the S&P. Coming up, we'll catch up with Jim Carrot of Morgan Stanley's Alphabet earnings found to spark a rally. The Republican Congressman Fred Hill at the House back to fund $1 trillion defense budget, and Ben Calloway of Bev with Elon Musk spending plans weighing down Tesla's stock. But begin this out with stocks adding to losses following an underwhelming start to take earnings. Jim Carrot of Morgan Stanley Investment Management joins us now for more. Jim, welcome. The numbers from Alphabet, the numbers from Tesla. Do we have a capex problem, a spending issue, or a positioning of price problem in this market?
I think it's a readjustment in prices. Honestly, I mean, look, there's been a lot of expectation. For many of these companies, the earnings have been decent. It's just that they're not meeting expectations in a way that maybe, people want them to going forward. And look, the earnings run so far for the first half of this year have been very strong. Of course, the market's forward looking. They're looking into the next 6 months, into the next 12 months. And what they're saying is that the pace of earnings is just not going to be what it was, because effectively this run rate of very accelerated earnings is really unsustainable. But that's okay, because these companies in this sector has actually been performing not so well this year. It's actually the value sectors brought in the market that's done better this year so far. So I think markets are being very efficient in terms of taking down some of these, more technology company prices and the growth sector prices in anticipation of slowing earnings going forward. So this isn't, to me, an alarm bell. It's just a natural progression of the earnings cycle.
So, Jim, just to build on that, peak earnings growth is a sufficient enough reason alone to stay away from these names.
I wouldn't say that, because it's a question of the valuation. I think that yes, second quarter earnings will probably mark the peak. I mean, it's going to be hard to put that going forward. But that doesn't that the run rate of cash going forward is going to also dry up. Well, from what we are hearing from the broader economy is that they have a lot of demand for technology, for compute, and for all of these things that many of these hyperscalers provide. So the demand, I think, is going to be there, and it's only going to grow. It's just that the earnings growth rate may not be as fast as it was, like in the first half of this year, just going forward. And I think that's why these, many of these companies are adjusting the price. And that's actually a very good, healthy sign. And meanwhile, John, as all of this is happening, the equity markets are holding up. And they're holding up because the market's broadened out. So to me, this is, this is okay.
How unusual is it, Jim, to see the stock market holding up and the broadening out continue with yields continuing to climb?
If we were having this conversation 6 months ago, 9 months ago, we would have said that if many of these hyperscaler stocks go down and bond yields go up, that would absolutely spell a disaster for, for equity prices broadly. But that's not happening right now. And I think that's a really important signal for us to take away. So is it unusual? Yes, it's unusual. Is it a shock right now? No, because what we're seeing is the other sectors of the markets, the other broad, if you look at the healthcare sector, if you look at the consumer, if you look at financials, if you look at industrials, if you look at materials, all of these other sectors are holding up in their for some of the losses that we're seeing in the technology sector that people are quite frankly weren't worried about.
Let's say next week, Kevin Warren comes out and announces that the Fed had just hiked rates by 25 basis points, is prepared to take further action to limit inflation, and frankly, gives what the market already has priced in. Would that affect things in a negative way or in a positive way?
Yeah, that's a really good question. I'm going to say that it's actually going to impact things in a negative way. And the reason I'm going to say that is, number one, I don't think that the Fed is going to hike rates, this year. But the other issue here is that this is a supply side shock. The Fed's tools, monetary policy, is there when the economy is overheating as of demand side issues, that are taking place. Higher wages, rampant hiring, a lot of spending, things like that. When you have a supply shock, when you have an oil or energy, shock that's coming through, a rate hike is basically just saying we're going to hike into something that's going to slow the market for the future. Higher oil prices is a headwind to the market. Why would you hike into a headwind into the market? It doesn't, to me, that doesn't make a lot of sense. So that's why I think the markets would take it negatively.
When it comes to what they should do, though, higher oil prices potentially can become entrenched in this economy, especially when you're dealing with an economy that is farm to road to table when it comes to things like groceries. At some point, is the Fed going to have to move, given the fact that last year they said the cuts were insurance cuts?
Yeah, so if it does become a pervasive, higher level of inflation that CB needs to look for, and it's becoming very, very permanent, then, absolutely, the Fed would have to hike interest rates. I don't think that we're seeing really, the material side of that we running through your large scale macroeconomic models, what they call the less models. So I still think, there might be incentives, and I think that more needs to explain that. But I think that, a lot of them are worst part of the cycle they have to be some we can look like
we're going into a meeting next week and we don't really know what's going to happen. Of new leadership. You've written about this, Jim. Do you think that strategically reducing volatility in the front end of the curve? We start there.
Yeah, I do, John. I mean, look, so the way that I think that Morty is approaching this is that he wants to have a temporary commission to fuel time policy for that. Another cycle. Think of the front end of the market as a shock absorber to inflation and inflation expectations. If you get the shock absorber right, you get a smooth ride from the back end of the curve. Normal stabilized rates. And that's what most people follow. Most follow just Thomas and everything else. So I think the uncharted territory that we're moving into here is that March will likely be more volatile in terms of the short on inflation and interest rate policy. But that's there to smooth out the long end. And I think this is a very, very different Fed right now that's going to introduce more supply side indicators, not just relying solely on demand side indicators to help make their policy decisions going forward.
We'll see if it works. We'll see if it caps along and yields. Jim, thank you, sir. Certainly not this morning. Jim Cannon at Morgan Stanley. Post GFC handholding might be ending at this Federal Reserve, and that's an adjustable process as long as they go through.
The goal was to reduce more volatility to control the long end. As you point out, it's not working in terms of controlling the long end. If it's intervention when it comes to balance, you could potentially offset this or treasury issuance on the front end. maybe then you start to see a marginal influence at a certain point that we're going to is only going so far.
The process, we're working through it. I think it's no way that we go into next week without really knowing what's going to happen.
Totally agree. I think it's best.
And that might be a feature in the bug for you. Right. It's a whole new world, the old world. Let's give you an update on news elsewhere this morning. Nice you to think that. Right? You start saying that every single morning. Let's get to Bloomberg. Rich Funny has a live on it.
Thanks, John. The ECB expected to leave interest rates unchanged as policymakers assess the impact of escalating tensions in the Middle East. The decision coming at 8:50 Eastern and 5:00 hours news conference 30 minutes later. Investors will be listening for clues on whether a September hike is likely. Mobileye reporting second quarter earnings that beat estimates. The company also announcing its founder and CEO, Anton Chaslar, is stepping down. Tune into VTech at 11:15 Eastern for Edgo's interview with Chaslar. An external review of the 2026 figure of Silicon Valley Bank would lead to takeoff at the closing first. Sources coming here at Bloomberg, it could provide a legal basis for the new Fed governor, Michael Barr, who had been responsible for banking oversight for SVB. And that is even when we start.
Well, thank you. Thanks for the update. Up next on the program, doubling down on the war.
We don't need to arm on street, but we do it because we have to do it because we cannot let Iran have nuclear weapons. So, they want to make a deal. But I say they're not ready to make a deal. They'll be ready pretty soon.
Republican Congressman Fred Show, live from New York City this morning. Good morning.
What is going to be the consequence of U.S. markets? They'll say mortgage gains across European equity markets. I look at how we're faring when it comes to Asian markets. In the world of decentralized finance, the NFTs have not recovered in the same way that safety did 20 years. Bloomberg is covering all things crypto.
It's a very spectacular story.
This is the future. It's the 21st century economy. The transactions
Snapped up nearly $1 billion in Bitcoin.
the technology.
We need to go digital for the gives people financial freedom and have a wonderful thing. And extraordinary.
He rides the rate that is Bitcoin. Bloomberg cryptos only on Bloomberg. At a time when policy in Washington is driving Wall Street, we draw a distinction between the rhetoric and the action, bringing you market-moving guests and original reporting. This is Bloomberg for Business.
Yesterday in the pre-market, down by 4%. In earning trading, pulling back following big decent results. In terms of earnings, revenue growth tremendous, $25 billion around there for cloud revenue, $2 billion plus more than estimates. CapEx seems to be grabbing the headlines. CapEx is building, free cash flow is guessing focus.
Yeah, certainly they got their first quarter of negative free cash flow in their history since 2016. Also notable that they're increasing their planned expenditures potentially as a result of some component costs. Like that, frankly, not giving any guidance of when it's not going to increase anymore. You can imagine that the others, the Microsofts, the Amazons, as well as the Metas, are all going to do the same things. Means that $725 billion in CapEx this year is probably whole lot higher.
Just this morning, pulling back, but only by a third of 1%. Pick out some of the tech names, Tesla spending more, Alphabet spending more, Japan's in the break. That makes them, they have been gaining over the last 3 days. But actually got some stability after the territory just last week. It's followed from the finance. It's the normal grind. And that is morning, now about 0.4. It's been that folks, it's considering yields, 2/10 fourth place for something. Institutions closing on the fourth, second, and tenders closing on the finance practices. 13. And more importantly, getting to these levels, went to the lakes for the year for people. It's all big deal for them. So stuff that we've said sometimes is really great as well. But when it's $1.5 in February, it's this number back, like $398. WTI around $90 this morning. So that's this morning, that went down.
We don't need the hormone straight, but we do it because we have to do it because we cannot let Iran have a nuclear weapon. So they want to make a deal. But I say they're not ready to make a deal. Because every time they make a deal, they want to change it. They're not ready. They'll be ready very soon.
So it's the latest this morning. House Speaker Lee Johnson delivering a win for President Donald Trump, Senator Thunder and Government possibly seeing that for each government.
The House did. The issue is we're probably going to see the Senate take us up very quickly as part of reconciliation with $3.5 billion. Part of that, as you mentioned, $73 billion funding, 12 billion $10 billion from debt incentivizing states to adopt the State of America Act. So all those are president's priorities. The issue is only the House is able to push it forward. And potentially would be a very hard vote in the midterm elections for some individuals to take that vote. And I don't see any there being active on this very quickly.
I was talking about a view from the House, the Republican Congressman French Hill voted to close the budget, saying this bill ensures a military as what it means for the test of adversaries and defending that news around Congressman Hill tried to see from more. Congressman, welcome back to the program. It's been too long, my friend. Let's get into some of these issues. You understand well the asymmetric nature of this conflict we have at the moment. The American workforce, the American military is spending an absolute fortune right now to fight and defend American interests and global interests for that matter in that strain. The Iranians are able to use very cheap one-way attack trucks. Do we really want to get drawn in to an enduring $1 billion siege building over in Iran for as long as the eye can see?
Well, first, thanks for having me back. It's always good to be with Team Bluebird early in the morning. The spending bill for budget reconciliation was important to make sure we keep our stocks high. And I think it's important for the American people to understand that after decades of trying to pay the Iranians, offer the Iranians diplomatic capability, the long-standing Obama negotiations, the risks to Iran having a nuclear weapon were rising, and Iran's provocative nature, threatening its Gulf neighbor, using terror with the Houthis to close the Red Sea, to attack Gaza, to continue to disrupt in Syria and Lebanon. I think the president just took the decision we have got to prevent them from having a nuclear weapon, which he initiated this spring. So I agree that Iran shouldn't have a nuclear weapon, and we also need global open seas in the Persian Gulf. I would hope that we would have more support around the world for those international waters. I think that's something that I've been a little disappointed in our strategy is not the maintenance of those sea lanes.
We do have the Senate Majority Leader, though, when it comes to the funding, saying earlier this week that he's not going to move on the House budget blueprint until the Senate solves the September 30th funding fight. So when do you actually think we're going to be able to get that money that you think is critical to our troops and military actually out the door?
Well, I would hope we could get that done before September 30th is the answer to your question. I think Senator Lewis recognizes that the House has now passed also, you didn't mention it, but a continuing resolution fully funding the government until December 4th. It's also a tool that John Thune has that he can bring to the Senate floor because he's fearful that Democrats in the Senate, once again, to try to get an election advantage if somebody considers it one, will try to shut the government down. Chuck Schumer has done that twice over the last, during this Congress, for the longest shutdown in American history. And what I think John Thune has now in his one, we have a CR to fund government with no additions through December 4th, so we don't have a government shutdown. And secondly, he could use the Budget Reconciliation Act in the Senate potentially to fund government for the rest of the fiscal year. So he's got some choices, and I'm sure he'll work with his new budget committee chair, Senator Johnson, replacing Lindsey Graham, on what those options are.
Was this a hard vote to take? The majority of Americans oppose this war, and now gasoline prices are north of $4 a gallon across the United States.
Well, I don't think anyone wants high gas prices. There's no question about that. And it's unfortunate that the Iranians don't recognize that they have a once in a lifetime opportunity to return their country to an open society, lives in peace with its neighbors, not the largest exporter of terror, are threatening Europe and Asia with ballistic missiles and a nuclear weapon. And so I think that balance is pretty clear to me. It's been 50 years, my entire working career. We've faced assault from Iran, killing Americans, killing our allies, threatening our interests, trying to assassinate our officials on our own soil here in the United States. And so I think that balance is just something we have to cope with. But no one wants high gas prices. What we want is the Iranians to come to the negotiating table and stick with a deal. That's what we need to continue to have our allies, including the Pakistanis and others, help forcefully make that case.
Congressman, can we afford a protracted fight right now with our yields climbing, with our deficits climbing, with the bill already significantly higher than some people were prepared to pay for?
Look, it's not whether we can afford really one of the challenges that we have in the world that we have to be prepared for. China infiltrating our telecommunication networks and threatening our infrastructure here requires a major investment. Countering that is a significant investment. Countering terror around the world that threatens our interests and our allies. Countering Putin's advances in Europe and his unwillingness to quit his invasion of Ukraine. All these things cost money, and America is in a leading position, both in intelligence and in military affairs.
Congressman, I guess I'm watching the bond yield space, not to surprise you, here in my seat, but I'm watching how yields have reached the highest levels going back to earlier of last year, looking at the fact that a rate hike is almost evenly priced in next week for Fed Chair Tevin worse. Do you think that hopefully potentially hike rates a bit to bring down the long end of the yield curve as the U.S. is facing all these bills that are more expensive to pay?
That's the decision the Federal Reserve will have to make. I think what we have to do as Congress is make sure we meet the needs of the national defense to counter the threats that we have, that are threats that we've inherited for decades and coped with for decades. These are not new threats, not new forces that we face, whether Ukraine, the Middle East, generally the Gulf, or Iran's threatening in the region. So I just think we have to be prepared, preparing for common defense, and funding that is one of our most important obligations here in Congress. We, of course, want the Iranians to come to the table. You've seen the volatility since February in global oil prices based on what is happening there. And the minute they come to the table, bring peace and work with their neighbors to help. So I think we see this is the answer, like specifically as the with the very wicked things.
Congressman, appreciate your time, sir. And good to see you finally get some testimony from a Fed chair in front of your committee this last week. That took a while, didn't it?
It did. Sure did very.
I'm sure you was. Congressman Frank Hill there on the latest at least. Up next, then kind of there on a few that's spending plans. We're at the epicenter of a global realignment on a scale not seen for decades. At the intersection between markets, economics, and geopolitics, a forum for sophisticated conversation. This is Bloomberg Surveillance.
Join me each week on the Wall Street Week for stories of capitalism from business, markets, economics, tech, and climate. More than what you need to know, it's what you need to think about.
Trading day is about to start.
You're already looking for that edge.
The opening trade brings you everything you need to know as markets open across Europe.
Let's talk about significant risk transfers to find space in their balance sheet.
Some of that risk. Look at the yellow page. Obviously, just having risk weights. I would much rather be long and then be short.
We're in a kind of sweet spot, very, very strong alignment.
Green revolutions and what?
I'm Guy Jones.
I'm Anna Edwards.
And I'm Tom Wiggins. This is your opening trade.
We trading machine.
Always upside. So yeah, get back to liquidity.
So we're lower, softer, negative. We're down by 0.5 on the S&P. We're down by 0.6 on the Nasdaq 100. Beneath the surface, some single name stories. Yohara will get to Alphabet in just a moment. That's the index level stuff. Still within 2% of all-time highs on the S&P. 10 to the bond market view highs for the year. 2s, 10s, and 30s. Bonds down, yields up by 2 basis points at the front end of the curve, up 3 at the longer end of the curve. We are just about taking out the highs of the year on a 10-year, 468, getting closer to 470, on 30s, getting closer to 520. And this move in crude's not helping. We've said that repeatedly. WTI and Brent. Brent crude closing in on 99. WTI now into the 90s. Only a few weeks ago, it was in the 60s. And if you turn to the bond market again and just sit on yields, this market, cross asset, there is a lot of paper competing for capital right now, and that includes the treasury as well. Typically, these sell-offs are self-limiting. Money comes in, things settle down, and of course, it's about a risk aversion in risk assets. The money goes back into bonds. You haven't seen that in a big way.
In part because the economy is still tugging along, and we are seeing incredible amounts of issuance. So if you are a bond investor, suddenly you have leverage to determine where you want to put your money and potentially what kind of yields you can demand to have the privilege of lending it out. And this is the reason why it's been the longest streak above 5% for the 30-year treasury going back, as Bloomberg calculated, to 2007. Does this raise a problem, or is this a feature of the moment, given the fact that this is a strong economy that can sustain itself even with yields at this level?
Societies, and we just hold on to those levels across the curve, 2s out to 30s and 2s comfortably above the rate of this Federal Reserve. Going into that meeting a week away. If we can't get to that meeting and the opening bell as well, let's get you some morning movers, some single names. Yohara has more. Hey, Yohara.
Hi, John. We started our latest earnings out this morning, and we are seeing American Airlines down 2.5% in the pre-market after the carrier warned it could see full year loss.
Down for break even.
Fuel costs continue to eat into office.
We kind of bring back there.
Let's rival the likes of Delta, always supporting things, and did reaffirm or raise
their outlooks. Meanwhile, we are seeing Alphabet shares falling in the pre-market, down nearly 5% now, as it raised its capex plans yet again to as much as $205 billion this year. And that's notable because Alphabet had been viewed as one of the companies where you saw AI translating into growth. Instead, the reaction suggests that investors are starting to question whether the spending is getting too big, even after Google Cloud revenue surged 82% from last year. And as Mandeep mentioned earlier in the program, margins came in much better than expected. And we turn to Tesla. Those shares now down 6.5%. And the debate around AI spending there looks a little bit different because investors have been wanting the company to ramp up spending because its future hinges on futuristic products like robo taxis, which are pricey. And while it did reaffirm its spending plans, and it's more than $25 billion this year, the company posted a big earnings list, just showing you how investors still want to see that payoff from all those investments.
Hara, thank you. More from you, Hara, in the next hour. On our radar this morning, Iran backed Houthi militants attacking 2 oil tankers in the Red Sea is their first attack on commercial ships since the war broke out and threatens the closure of another key choke point in the Middle East. Elsewhere, a review of the collapse of Silicon Valley Bank is sparking a political battle. Sources telling us here at Bloomberg that some officials are weighing removing Fed Governor Michael Barr from the board. Barr was vice chair in 23 when the bank collapsed. And finally, Uber cutting 10% of its customer service roles as it pivots more towards AI. The company highlighting they've already made strides in using the technology, saying the move will help further streamline operations.
And this follows another round of cuts at Uber earlier in June in its so-called people division. A significant part of that, although they don't break out exactly how much that is, of the overall staff. There have been a number of companies that have come out and make announcements like this. Block, Oracle, others have said this is an AI-related round of layoff. It's treated differently. Sometimes it's treated as just the overhired staff efficiencies. What we're hearing from companies is it's not this obvious. You can cut staff in one place, but you're going to have to put the money in other places as well. It's not as clear of an efficiency. In some ways, our stock market's looking for that type of efficiency and just not getting it. I'm not sure what the full read-through is, but when you talk to people like AT&T, they're saying anything that we save we pass to our bottom line. It's not going to ultimately help us. So this is the reason why you're seeing sort of an ambiguous reaction in markets.
It's a great point. The fact that they already did layoffs, and this is the first time they're tying it to AI. So you have to think, is AI just the latest flavor? Is the scapegoat to actually shrink their workforce? Come at the same time that Jensen Huang is saying, the fact that this is going to destroy half the American jobs is complete nonsense, talking about AI. I'm hyper focused on what companies do when it comes to blaming job losses and letting go of employees because of AI, because this is going to be a massive midterm election issue, and this will be the issue for 2020.
Let's hope you're moving on the politics. For now, in the market, I'm focused on the ROI. It was an interesting example because earlier this year, they were the example of a company rationing on AI. And this is a suggestion this morning to optimize their spending the fact use case for it. At least with regards to customer service. So if you want to finish some of these right now, point to that and say, a lot of people point to Uber as part of their case. Small and I'm not sure you can do that.
Well, ultimately, this is return on investment that they want to be able to see, they want to be able to disclose. What's interesting is how few companies have actually done so. Uber is talking about it in customer service capacities. We've heard that from other places, but we did hear the same thing with AT&T. What do you do with those savings, though? Is another question. I mean, I'm sure there have been layoffs in a lot of places, but they haven't announced them. Maybe Uber's trying to prove the ROI in some capacity. What you are hearing, though, is that they're putting that money elsewhere, which is causing jobs to be created, et cetera, or potentially just making better competitive landscape. It's unclear to me why companies can keep spending the same level of what they have been on AI, given the fact that they cannot articulate an ROI to investors. It's just going to make them better, more competitive, broaden their footprint. It's an interesting moment, but it's not so clear.
I don't like the chatbot service operators anyway. Do you? Not a big fan.
I don't love them, but I will say one thing about Uber, if you, and Lyft, by the way, say this is why you use your car, and they think it's an acceptable reason, they immediately and you don't have to go talk to anyone anymore. That is all automated.
Okay. Sometimes. Because sometimes they don't. Because I've had that fire as well more recently.
Oh, really?
Recently. Yeah.
When you have to get a
No. I just haven't down there. I've waited up. I don't want to go into too much detail because I can't work because we're here now. So we're doing it. If you schedule the car.
Oh, this is bad. This is bad. This happens to me too.
If you schedule the car and they don't get out of bed, you have to wait until the time you're meant to pick you up and you cancel it. Even though you can see that car's not available. Like, see, you get cancelled, they want to charge you for scheduling the car. Because when you wake up very early, you have to see the driver to fix a job, and then they just say, yes. So this has happened. Like, whenever I'm late to work, you know, why?
This has happened.
What's happened?
This has happened to me too. And then I usually end up going back and explaining to them.
And then you ain't like, sure.
Yeah, but it does take a lot of work. They should automate that. AI automate that.
Nobody's interested in this conversation, so I'm sorry, but we went that's what I had to explain. Let's talk about Tesla. Shares falling in the pre-market. The EV maker announcing plans to spend up to $25 billion this year on AI initiatives, and even more in the years ahead. CEO Elon Musk saying, I think on his call, we should be spending on capex as fast as we can without it being too wasteful. Ben Gallo of that remaining bullish, writing, we believe this elevated capex program lays the foundation for several years of future earnings growth. Ben, John just down for more. Have you seen evidence of that to the program? Have you seen evidence of that already? You know, this spend at Tesla is worth it.
Well, just in your previous conversation talking about Uber and AT&T, it's interesting to me that Tesla is strong. We'll have to wait for a driver for sure. It's normally, you know, AT&T will have that.
That's true. Ben, that's true. But we're seeing that already, that competition right now. When you look at the robo-taxis, the rollout so far, are you impressed enough? You've seen sufficient progress?
I've been covering Tesla for since it was covered basically. You know, it's only the next, you know, the full self-driving next year. I do think that we're still right now entering new territory. The number of taxis that are unsupervised is still small. You know, I do think that there, you know, I believe Elon says that it's safety issue. You know, they do get a lot of press. The car, they said like so. We have to be very careful now, and then they're rolling out a new product with this cyber cat. And so there's a lot going on there, but I think that, you know, over the next 2 years, there's going to be a really dramatic increase in the
Ben, I remember when Tesla used to be a car company and people would get excited when they sold a lot of cars. They actually had an incredible quarter when it came to selling cars and nobody cared. I mean, essentially, is that sort of an afterthought when it comes to the robo-taxi and some of the AI-related aspects of the company?
It's a great question. I was thinking about this morning because it was you know, a very good quarter in the auto business. You see across many different regions, you know, demand increasing. There's so many words about Chinese autos, but I think that everyone's kind of looking forward, or many people looking forward to Optimus and to robo-taxi into you know, with the Terra Fab, the solar plant. The other things are doing SpaceX.
With respect to the spending, it's been harvesting capacity to ramp up CapEx, let's say an Alphabet because SpaceX does, given their footprint, because it's a question of their achieving some control.
So on the CapEx, you know, it's hard to keep up with the hyperscalers. I do think that that's one reason SpaceX and Tesla make sense as a combined entity. I think we saw, you know, Alphabet go to the market, raise capital, raise the CapEx, and races on. And so SpaceX, Tesla, the combined company, you know, it's going to have to keep up with that. So I think, you know, the bigger the better in this type of market right now. And that's one reason I think we'll be combined. And, you know, when the general counsel on the phone, I've been on a lot of conference calls. There hasn't been a general counsel answering questions like last night.
Well, I think he has to, right, when it comes to actually the past too, in terms of how Elon Musk has talked about some of these issues. He did talk about the growing overlap. Do you have a timeline?
I think the sooner is the better. You know, because the race is on. You know, deploying capital in the race for AI, whether physical or not. The one thing that, you know, gives me a little pause is that as the entities will be combined, there will be a period where You have to go through the local races and it kind of walks them up for a bit. I mean, they can still progress with the business, but it does create like a standstill if all regulatory. But I would say within the next 12 months.
And what is the stock story then for Tesla at the moment? Like, what do you do with the name? What do you tell clients? What do you tell investors? What does this even look like? We're just sitting here waiting for the same thing to happen at some point in the future.
Well, I do think that Elon is going to have to, or he will, give a premium if they merge two companies together to test the shares. I don't think the shares are reflecting that right now. If we do like a VWAP or your average trade price, you're driving your $400. If you put a 20% premium on that, you're at 480, and the stock's not really indicating that at all. And so, I think there's a lot of opportunity for investors. And if it doesn't happen, there's a lot of good things happening. They're working already now. I think having a long stock right now as they build out the physical.
Ben, it's good to see you. Thanks for making time for us. A busy morning for you. I know Ben Cameron there. Ben following numbers from Tesla. Their stock was slightly lower in the pre-market, down by 5 to 6% over the last few hours. Let's see an update on news worldwide this morning. We have Bloomberg Brief. Vonnie Quinn has more. Hey, Vonnie.
Hey, John. Oil closing in on $30 a barrel now as tensions flare in the Middle East. Iran by Houthis claiming responsibility for attacking Saudi Arabian tankers in the Red Sea. The U.S. conducting a 12th straight day of attacks on Iran. U.S. and Saudi Arabia are finalizing a nuclear technology sharing deal that could allow American companies build reactors in the kingdom. The deal could also allow Saudi to enrich its own nuclear reactor fuel. The deal now goes to Congress for approval. OpenAI spent just hours hacking Hugging Face's internal systems last week. Sources telling us here at Bloomberg the hack would have taken a skilled human a couple of weeks. OpenAI has been in contact with the US government since learning of the breach. And that is your Bloomberg Brief. John.
Vonnie, thank you. Everybody's no session lows with down 0.6 on the S&P 500. Bond yields near the highs of the year, 433 on twos, 10s, this far away from breaking into 470. Up next, another shock to the global economy.
The inflation situation is extremely complicated.
Central bankers think that monetary policy has got much more to do with it than it actually does.
Let's not make the mistake of thinking the US is the only central bank that needs to sort out where it stands in the next phase of the global economy and get in the right place.
Up next, we'll catch up with Darren Matt of HSBC from New York City. You're watching Bloomberg TV.
Well, mentor Roger Staubach who told me when I transitioned, football will never leave you, but you need to leave it. Wow. Everyone has a dream, and a lot of kids are, like when you used to play football, you get the dream come true, and it is going to end. And the day it ends, the day before it ends, you're one of the best in the world. Great. The next day you wake up, that's gone. What are you great at? And the truth is nothing, right? I'm not great at anything else.
I talk about it all the time, Steve, is this whole idea of it's not some penthouse, it's penthouse. And what I mean by that is you play for 15, 20 years and you're in the penthouse. That doesn't mean that you come to the business world and you're going to be in the penthouse. Now, you don't start on the third floor or the lobby. You actually have to start in the basement.
The global economic playbook is being rewritten and the levers of power are moving in real time.
To see where the world is headed, you have to look where the action is.
I'm Haslinda Amin in Singapore.
I'm Menika Doshi in Mumbai.
Welcome to Emerging the New Economy podcast.
Each month, we dive deep into how the world's most exciting rising economies are shaping the global future.
Join the conversation. Subscribe to Emerging on your favorite podcast platform today.
Good morning. This is Bloomberg Savannah.
Welcome to the opening trade.
It's Bloomberg money.
This is the trade.
This is Wall Street Week. Welcome to Balance of
1986. That is incredible. 1986, you got to go back to the last time the dollar yen was at this level. And again, the dollar yen is at the highs of the day, new literally 40-year highs here on this. And again, most people don't understand the implications of this, but it has a lot to do with the money flow between Japan and the US, the carry trade. And ultimately, we've seen historically that at these levels, intervention is very likely, and intervention can shock the markets, like in August of 2024, when it caused a 15% drawdown in the NASDAQ in a matter of 2 weeks. 2 weeks, guys, 15% downside. Now, again, there's no guarantees it happens. We don't know that. But as a strategist, my job is to look at all angles of the market and figure out what the risks are here. And this is definitely one to keep an eye on. Now, even with all of that, we haven't even touched on the earnings picture just yet. Before we do that, let's go to the S&P daily chart. The S&P daily chart will be opening lower today, down about 1%. Again, all I'm watching is this trend line and this trend line. Which way do we break out of this wedge? We discussed yesterday how this is technically bullish consolidation. So your favoring would be a slight favoring to the upside of a breakout. But if it does fail, that's where all HELL breaks loose. That's where things get very crazy. Okay, so again, keep it on your radar. Tesla is getting crushed today. Now, remember, yesterday we talked about a wedge pattern that the chart of Tesla was sitting just on top of. Now, Tesla missed earnings and their CapEx is going up. They are now a net negative cash flow company. Google, same thing. These companies that were literally printing money, they were making so much money, are now all cash flow negative. That again, there has to be a valuation reduction based on that, because we don't know if these investments, the $200 billion that these companies are spending, are they going to pay off? Are they going to pay off for that type of investment? We don't know. And so they have to be discounted accordingly. Now, if we go back to the Tesla chart, I got to show you this because this is fascinating. So one of the things we were watching was a major trend line right here, right? And we saw that going into earnings, we were right on that line. Well, guess what? I don't think there's any question that we've broken that trend line on a gap down today. Now, as a day trade, is this level around 337 good for a day trade? Yeah, I'm going to be eyeing that. We're not far away. We're about $6 away. So as a technical day trader, I'll be eyeing that. But what about as a swing trade? If this breakdown, which it looks like has occurred, how much lower is Tesla going before it becomes a swing trade? I want to show you this because it's pretty darn cool. So what I want you to do now is let's use a parallel channel. And what we can do here is we take a trend line and we drag it down here. Now you might say, okay, well, that's a trend line, right? Right? Okay, yeah, you're right. It is a trend line. But then bring a parallel up and look at this. This is where the awesomeness starts to come in. And I'm going to change this to yellow here just so it pops out. So you have the parallel in orange. You have this trend line in yellow. We've broken the yellow. What do you guys think this means? All right, well, we know that price, since it got in here, has gone up, touched the bottom, rallied up, touched the high, touched the bottom, touched the high, high, high. Where do we think this is going now as a level for a swing trade? And the answer would be very simple. Down here, the lower range of the technical trend line. If we bring that out, basically that brings it out to about the 290 level right down here. So that's where I'm going to be looking. But isn't that amazing how just putting literally a trend line here tells us it broke, right? Because you can see the trend line pivot low, it held here. It was also the low end of the parallel and it touched here and now it's broken. So the odds favor a move down to there, and look at the parallel. High pivot, high pivots, high pivots right in here, right? And then we had this high go to this gap up low to here and to here, and look at that. That's your target on a swing trade basis. That's really cool, guys. I love it when the charts just make so much sense. And again, just because they make sense doesn't mean it has to go there. Remember, everything we do is probability based here at Verified Investing. It's what are the charts telling us the higher likelihood scenario is. And right now with this breakdown on Tesla, it's saying 290 is likely within a month or so. And then that will be a bounce level where I likely will buy it. And that's nice to be able to have make sense out of chaos. Google, Alphabet, big drop here as well, guys. Again, their earnings were honestly fantastic, but cash flow negative, and also the CapEx spending is going up. Not only are they raising it to about 200 billion this year, but they said it's likely to go substantially higher next year. I mean, this is nuts, guys. The amount of money that these companies combined are spending on a yearly basis is well over $1 trillion. Now, to put that in perspective, you go to COVID and the government was basically spending thereabouts. So, I mean, we're getting the types of stimulus, maybe government was doing a little bit more then, but the point is the amount of stimulus that the AI CapEx spend is generating is incredible. Now it's on a specific zone of the economy, but it is still an incredible amount. And you have to wonder, is the payoff going to truly be there? Is it? We don't know, but it is a risk. These companies are really laying it on the line, and they must be either pressured by the fear that they're going to be left behind, or they know something that for certain that I don't, which is very, very possible, that the payoff will be great. But either way, the stocks are getting hammered. All right, Google, where's the level? Here it is, guys. This is the day tradable level down here, just below 320. You have pivot high, gap fill, and then the ascending trend line. That's a good level. Would I swing trade this level? It is actually intriguing for a swing trade as well, but I'm not ready to commit. But I do think it's important to note that Alphabet is now down at these levels over 20% from its recent highs, just going back to basically May. So that is a big fall here, guys. All right, Texas Instruments down on earnings. That's a chip player. The chip stocks actually were generally trending up this morning until the futures rolled over. So even in spite of Texas Instruments, we were seeing some money flow going into those, probably because the CapEx spending is going up. So what are people going to spend it on? Chips, memory chips, things like that. But again, Texas Instruments down a little bit. If we look at the chart here, I don't have a day trading level, but one of the things I'm going to watch very closely is this trend line right here. It looks like we might break this today. We are below it in the pre-market, but we got to watch and see where that goes. ServiceNow had been pounded going into earnings. So it's a software player. It is bouncing a little bit today on the daily. It's not a big enough bounce to get me excited. This would honestly have to trade back gap fill at 111.30-ish to 40-ish to get a short off as a day trade. And as a swing trade, I don't have confidence enough in the factors. IBM is under pressure here today. It's only down a little bit. Remember, they warned about a week ago, but the stock is coming down. I do have a big level on IBM around the 195 to 197 level right here. Look at these pivot highs going back to 2024. This does look very interesting on IBM. This morning, American Airlines reported earnings. The stock is down. I think part of American Airlines being down is the earnings, but also it's oil, right? So if you look at almost any of these airline stocks, they're under pressure because oil is soaring. So that's that big cost factor that is driving it up. So we'll see where that goes on that. RTX, good and getting a good bounce. RTX is Raytheon. Lockheed Martin is up as well on earnings. Let's be frank. Is anyone somewhat even surprised that both these stocks are gaining today? Think about the military action in Iran and think about the government spending on military. And both these companies are right there. So I've heard we were depleted on missiles, we're depleted. We got to get drones going because that's cheaper. But again, all of these players here, they are right there. And so again, I'm not surprised they're trading up on earnings. LMT again opening up, and you can see it wasn't even at its highs. Going to have a little resistance around 551. And then if we look at RTX was pretty close to the highs, but double top around 215 right up here. All right, back to oil. Oil continues to push 91.50 right now on WTI. I'm watching that 93.40, 50% Fibonacci retrace as the next level. But look at this, guys. Gold today. Look at that. Yesterday rallies up into the upper band of the wedge. Got to throw a arrow in there to keep it going since we have all of our arrows marking here. and look at today, right back down. What a slam down on gold, guys. Gold is down 2% on the day, just like that as the dollar rips higher. And then what about silver? Look at silver. It's also getting hammered. Had really 1, 2, 3, 4 up days in a row, and then right back down, giving back over 50, about 50% of the move just today alone. I still am watching the 4 up here. We came so close to. And again, sometimes I wonder if when I talk about these levels, just like in the trading room, sometimes people buy just ahead of the levels, which is okay. Listen, you guys can make your own choices. I sit waiting patiently for the levels to hit. Natural gas, guys. Nat gas has started to catch a little bit of a bid the last few days, again, possibly on the back of oil. I'm also hearing more and more chatter that there's going to be actual shortages of natural gas over the next couple of years due to the usage in data centers. So we know data centers don't have enough energy. They're going to have to go out and buy their own energy. To really run it. It can't be pulling from the grid and driving all of our energy prices up 30, 40, 100%. So they're going to have to buy their own energy. Now, listen, in a way, that's going to drive up the price of natural gas, which is going to probably affect us anyways. But the point is that if that's true, nat gas could be on pace for $5 within a year. That is a possibility that I think needs to be discussed more and more. Lastly, guys, as I got to get to my trading room, Bitcoin coming back in. Watch this level on Bitcoin, 67,000. That's this pivot high. We kissed it and pulling back a little bit. Again, that is a level I'm very closely watching on Bitcoin. We break this, we go to the factored or calculated target of the inverse headed shoulders, which is 71 to 72,000 on Bitcoin. All right, guys, today is going to be a wild day. All right. Not only, again, do we have oil making a bigger move today, pushing through resistance at 87.88 to now 91.50. Again, with resistance, the next level at 93.40. But we have gold and silver tanking. The dollar yen is surging. We have the dollar ripping to the upside. 10-year yields above 4.75% or 4.7%. And then we even have the stocks that are falling on earnings. Lots going on here. All right, I got to get to my trading room for day trading, folks. Again, if you're interested in swing trading, come check out the services, the smart money services at verifiedinvesting.com. Those, again, are swing trading. You see my live portfolio, my exact shares entered, literally alerts going out instantaneously. You get it all in those services at verifiedinvesting.com. Have a great rest of your day. Thanks again for tuning in. Take care.
Thank you and good afternoon. I'm trying to talk a bit more on, what's been discussed on potential hikes. Given that there was some sort of push for a back-to-back front-loading type of hiking today. No, there was no push. Push is the wrong word. Okay, fair enough. Who has the burden of proof going into September? Is it on those arguing for a hike or is it on those arguing against a hike? My second question is on the minimum reserve requirement. Did you have any discussion about raising it and or will it be open for discussion in the next months? Thanks.
So my answers will be rather short. The burden of proof is on data. As simple as that. On the minimum reserve requirement, it was not discussed on the occasion of this governing council, which doesn't mean to say that it will not be discussed.
This question goes to Anders Sturm for expansion.
It will, as it has been, by the way. This is not something that is, thank you. not really for us to decide. It's a matter where we give views, particularly in relation to inflation. It's a matter that is essentially under the consideration of the European Council and the Commission. As you know, there is a process. Bulgaria went through that process successfully, and we are, always ready to welcome more members as long as they satisfy the requirements and comply with the criteria, and the convergence conclusions is positive. So we'll see. It always, as you know, it always takes a little bit of time. But ultimately, all members of the European Union, except for one, are expected to join the euro area.
And the last question today goes to Marta Villar of the Econ Stream. Marta, please.
Good afternoon. Thank you for taking my questions. Madame Lagarde, would concern about second round effects alone justify another move in September, or would you need to see evidence that they are in fact materializing? And my second question is about the market implied rate path. You often point to the rate path embedded in the staff projections. How important is the market implied path for policy decisions? Thank you.
So if it was just a matter of concern, we would have raised time, because whenever there is a shock of that nature, we have to be concerned about direct, indirect, and second round effects. So we are concerned, which leads us to being very attentive, looking and sort of checking any possible emerging sign that second round effects are not only in the making, but in the coming, and more so than what we have in the baseline. We are not at that stage where we are seeing those emergence sign of second round effects. Okay. Additionally, by the way, we have inflation expectations beyond the short-term ones that are broadly anchored at our medium-term target, which is also important. The rate path implied that is market determined is something that we factor into our work, because obviously we take certain market conditions at a cutoff date, and that includes, of course, the market rate implied trajectory. Thank you.
Thank you. That concludes our press.
Wait. I want to say something. I want to say something because I don't know if we still are on the stream or not, but I just want to take this opportunity to congratulate the Central Bank of Bosnia and Herzegovina, as well as the Central Bank of Montenegro, on their successful launch earlier this week of a platform for the settlement of instant payments, which uses the technology of TIPS, the Eurosystem's fast payment system. We don't often talk about that because it's a monetary policy focused press conference, but this is important. So I'm looking forward to a similar launch in Albania, Kosovo, and North Macedonia, which are expected to join in November, bringing all countries participating in the initiative onto the platform. And I would like on this occasion to thank Banca d'Italia for the key role that it has played on this initiative on behalf of the whole Eurosystem by developing a clone of TIPS for the countries of the Western Balkans, which, except for Serbia, are now all going to be included in November within our TIPS platform. You should expect some further development in relation to interlinking existing fast payment systems, but that's for a later date. And I know that some of you are going to stay a little longer, maybe writing the articles and news, because we will soon be disclosing in that very room the set of proposed new banknotes, the new euros that will have a different face, different back, and that will be in the pockets of European citizens when the project is completed, after hopefully they have participated in the survey. With that, I hope to see you in about half an hour.
That will be at 4:15, and the next press conference will be at our External Governing Council in Berlin on the 20th September. Thank you very much.
You have been watching the ECB press conference from ECB President Christine Lagarde speaking in Frankfurt following their decision not to change rates. You're watching Bloomberg Open Interest. I'm Danny Berger along Isabel Lee. So yes, it was the ECB that decided not to change rates, saying that a full impact of inflation, of an energy shock, has yet to play out. They're not seeing any second order effects, but Madame Lagarde, they're pointing out that she was concerned that we might see some. There was no push for an ECB rate hike, according to Lagarde, but some governors asked themselves if a hike was needed. We're just quickly saying the background of what's happening in markets because markets are open. Alphabet getting hit hard in today's session. Isabel Lee not helped by maybe hawkish expectations for central banks given
Not help at all. Recent shares falling more than 6%, erasing $265 billion. Danny, we have a lot of tech earnings to digest. I'm pretty excited. We have Tesla, Alphabet, and a whole slew. Even American Airlines. I mean, you and I travel a lot, so it's definitely in our interest.
Excited, but the market is maybe disappointed. But first, it needs to wrap its head around the macro backdrop. Let's bring in Seema Shah, Principal Asset Management Chief Global Strategist. Seema, we just heard from Madame Lagarde this idea that we haven't fully seen the second order effect. She's nervous about from higher energy prices. We're feeling it today. Triple digit oil, $100 a barrel for the first time since May. At the same time, yields rising after in the US we saw the lowest jobless
Back on the open,
69
talking to value.
bracing for rate hikes, both from the ECB and possibly from the Fed next week.
Hi, Danny. I mean, just looking at the data, looking at the way that the market is moving, oil prices are moving today, certainly suggests that the ECB is online to have another hike in September, potentially one after that as well. So she's being quite careful and cautious with her comments. But certainly, as she noted, the mild scenarios were very unlikely given the latest developments. So I think we have to put a lot of weight on that. When it comes to the Fed, I think it's a little bit more ambiguous. I mean, we are expecting at this stage that the rates are going to stay on hold through this year. But the odds of a rate hike are increasing with each additional day that these trends persist and oil prices stay higher. Because of course, just like Lagarde, same thing for the US. Second round effects are the real concern. So that's the key thing that we'll be watching out for. But next week, we don't expect any move.
Seema, what does it mean then for risk assets when you do have 2-year yields at the highest since 2025? Or you don't expect a move for next week, but might we be getting to a level even with longer term yields that have been sticking above 5% for the 30-year yield for the longest stretch?
if you want to really get into the intricacies of VPA style trading. Been kind of weird since trading at 10:30. Let's move into Japan. Oh, nice. Move to Japan. Very cool. I'll come hang out with you when I come visit Japan. When I read Edmund's book, my main takeaway was small candles with large volume are fake. The volume should match the candle. Yes, that's called an anomaly. A large candle with large volume, I'm sorry, a small candle with large volume or a large candle with no volume. Those are both fake. Those are anomalies. Right there. Did you take a trade this morning? I did, and you don't have to call me Mr. M. I prefer Captain OM. Good sir. Another big top week. Rolling back over. Only 8,730 rolling back over there. Still looking for the low today of 660. Why did the markets get wrecked? Yeah, well, earnings was yesterday. Earnings were yesterday and they dumped back over. Bad stuff. Not to mention that the macro charts do appear to be breaking down a little bit. The NASDAQ has kind of crossed the point at which you should not cross. Another sweeping bottom for some top wick here, down to 656, low of the day. If they do claim 656, of course, no volume, and with no volume, we're going to be looking for 548 next. That's the next target here. Options are very bearish. Price action is very bearish. Liquidity is all lower. They just smoked all that liquidity on the S&P. We had a ton of liquidity at 74.50. On back down. She's moving. She's moving. I went to ban you from posting memes and gifts. I did not ban you. I did not ban you. 28,712. Almost there. Almost there. Coming back down. Are your trades on the Discord or the website? On the Discord. Yeah, on the Discord. And this 15-minute candle has top wick like 3 times. Top wick, bounce back up, top wick, and bounce. It's just expanding and contracting. Expanding and contracting. It's like a trading version of a shake weight. I understood the reason for too fast and the bounce on the Monday level. Do you have a bias that you go into the session with? I do have a bias that I go into the session with based off of the overnight session. The overnight session does give me an idea of what I'm going to do here at the open. So if things are aggressively bearish, and then we're coming into a weekly level, I'm looking for a possible bottom wick to move back up. It all depends on where we're at and what the volume is and what the wick is. Right here. Yeah, appreciate you, Taylor Adam. If you wouldn't mind hitting that like button, helps the algorithms kind of latch on to this baby and get the word of VPA out in the open. We need more VPA and less ICT. Appreciate that. More absorption here. Working. Test of 657. The S&P is dropping here too. Another top wick, and they're going to go to 74.5. We just filled about 1,500 lots on Bookmap, right at 74.50. A whole bunch of liquidity sitting at 74.50. Not too basic. No, absolutely not, David. Keep them coming, buddy. Keep them coming. $20,007 tickets. Another top wick, expanding and contracting over and over and over again. Right here. Starting to trickle off on some selling of puts. Right here. I need yesterday's slap in the face, bring the ego down. Yep, the market will do that for you. Every time you get your ego start getting punked, it'll slap you down. It always tend to do that. Another top wick, bottom wick on the 30-minute. They're still putting on liquidity at 74.30. Let me show you this on Bookmap real quick. Another top wick. You see all this liquidity here at 74.50. Just coming down. $49 and $51 right there. What is that? 1,700 lots sitting there? The buyers are on the clock here after such a negative move because we all get sucked into today's trading range. All of retail, their eyes are just glued to right here. Like this is their world right now. Like this is how their charts look. This is all they care about. But they don't realize that this is what they should be looking at, that we are down from 29,282 overnight and 29,342 from the highs. So we are down 300, 600, almost 700 points. And the buyers cannot get this thing up. So the buyers are on the clock here. The longer that the buyers fail and the price action stays at these lows, the more likely that we start downshifting to the next target. This tells me that we haven't hit demand yet. If the buyers haven't engaged to put in a high, we haven't hit demand yet. The way we know if we hit demand is we have high volume with a bottom wick and we start to put in a higher high, at least on the 15-minute chart. If we can't get that, then we haven't hit demand yet. There's no sign, at least there's no signs of that. They could be doing it, but there's no sign of it. At which point, the probability starts to shift to the likelihood that we start tapping 657 and then down to 548 until we have a high volume step to focus a lot of it. What's up, Ryan Brown? How you doing? Appreciate you, buddy. Appreciate you. And that's what I'm looking for here. Made it. Good buddy. That's correct, Tricky Doug. So after you do that, shoot me a DM and I'll get you hooked up. How can you tell if the liquidity is legit or fake? Yesterday they had almost 1,100 combined. I mean, range is 39, 25, 40. I mean, you don't really know. It happens. Sometimes they do that, sometimes they don't. That's why you can't fully rely on any indicator. You can't fully rely on options data. You can't trade off options data completely, and you can't do the same. You can't trade or rely completely on order flow. You have to have a combination of price action, DPA, and then look at those tools. So if the order book is incredibly bullish and the price action is starting to look bullish, you could play towards it. But there's going to be a time where they're going to start to diverge. When price action starts to distribute or accumulate, you're going to have some cross currents. Are those orders that they want to be filled? Yes. Well, I don't know about them trying to go back up. It depends on the skew. So if we continue to roll the liquidity back down, like when we blasted up higher, but 2 days ago, they were blowing the liquidity higher and higher and higher and higher. They kept drifting higher as they went. Yeah, they're about to pop 656 here. 660. Bam, okay. Glenn, good morning. How you doing?
All right, we're finished today. Got everything before the IB formed. Just right in there.
Now gone. 7450 now.
Another 10 minutes here. All right. Actually,
yeah.
Probably another 15 minutes here. Yeah.
This is still in next week. They just tapped their overnight low position for the second time at bottom. Right? Saying that right. If you are starting to sell off some goods, we went from